all. So this is a work in progress study that is about looking at the disparity between India and international gold price. The objective of this study is to understand the factors that causes the disparity between the India and the international gold prices, and further, what is the magnitude of impact of these factors on the gold price disparity. Now, what is the disparity between the India and the international gold prices, and how do we measure it? So we know that the gold spot price in India and the LBMA prices follow the same trend. However, they do not perfectly mirror each other. There are consistent disparities between the two prices, and which leads to premiums or discounts in the gold market. Now, interestingly, yesterday there was a presentation on the gold premiums and discounts, and they looked at the days of week and month of year effects on the premiums and discount. However, our study is slightly different. Like, we look at premiums and discounts from a slightly different perspective, and we adopt a different methodology to understand the gold price disparity in India. Moving on, so we use the gold premiums discounts data published by the World Gold Council as a measure of the gold price disparity in India. So the gold premiums discount is calculated as the difference between the MCX spot price and the landed price of gold, which is the LBMA EM price, plus the import taxes levied on the gold imported into India. Now, this is the plot of the daily gold premium discount series from June 2005 till mid 2022. And as we can see that there are time periods when the gold price disparity is quite small, while also there are instances where the price gap is significantly large, with the premiums being at the highest of $162 per ounce in December 2013, and the discounts being lowest at $90 per ounce in March 2022. Also, the red line depicts the key events in the economy as well as the events specific to the gold industry. The first one shows the onset of the global financial crisis in the mid-2007. The second one is in the Jan 2012, which was the removal of the fixed custom duty of Indian rupees 300 per 10 gram. Then in 2013, we had the increase in custom duties from 4% to 10% in different phases, the introduction of the 80-20 policy. Then towards the end of the data series, if you see, we have the COVID-19 first wave and the Russia-Ukraine war. So interestingly, around and after these events, the price disparity has been relatively high, so which makes us more curious to understand the causes of the gold price disparity in India. And as we can see in the plot that most of the time, the gold in India has been traded below the international price as depicted by the discounts in the gold market. Now, what is the motivation? Why it is important to study the gold price disparity in India? Firstly, it has implications for the Indian gold market and the economy. So frequent and large deviations may create arbitrage and speculative opportunities in the gold market. Also, a wider gap would mean more opportunity and increased smuggling. Secondly, it is important to understand understanding gold price disparity provides significance for policymakers and regulators. So as we know that the gold industry in India is heavily regulated, and the government imposes stringent regulations to curb the import of gold. Hence, it is important to understand how these policies impact the price gap. Lastly, given the affinity towards gold shown by the Indian households, which makes it critical to understand the gold pricing, how the prices faced by the Indian consumers has evolved relative to the international gold price. Now, in terms of previous studies, there has been abundant literature which has looked at the impact, which has looked at the determinants of gold prices in India. Also, there are studies which have looked at the interlinkages between India and the international gold price. However, like to the best of our knowledge, there is no previous studies which have looked at the disparity of the gold prices in India. So now moving on to our data set and the methodology. The price disparity between India and the international gold price is our dependent variable for this study. We use the absolute value of the gold premiums discount as a measure of the gold price disparity in India. So now this series is published by the World Gold Council from 2012 onwards. However, prior to 2012, when the import duties were fixed, we estimated the gold premiums discounts using the methodology provided by World Gold Council in order to get a continuous series from June 2005. And the daily price disparities are averaged on a monthly basis to construct the price disparity variable used in the regression. In terms of our explanatory variables, we use the gold imports, custom duty, exchange rate, LBMA gold price, the gold contract volumes traded on MCX, and the Nifty index. Apart from imports, all the variables are monthly averages of the daily data. So the data set of monthly frequency is constructed over the sample period from June 2005 till November 2022, consisting of 210 data points. So these are the summary statistics, which shows that the minimum value of price gap has been 1.87, going maximum to 149. And the below graph shows that there are the presence of outliers in the extreme values in the price gap series. So in order to avoid any spurious regression estimate, all the variables have been tested for the presence of unit root. And yeah, moving on to our methodology. So we use a quantile regression approach to understand how the factors affect the gold price disparity in India. So generally, this method is regarded as more versatile and informative, and it is very robust to the presence of outliers in the data. And further, this methodology allows us to understand whether the extremely small and large price gaps respond differently to the independent variables. This is the general specification of our methodology. So this is our regression specification, where on the right-hand side we have the exchange rates, gold imports, custom duty, LBMA gold price, Nifty index, and we also include the lagged dependent variable in the regression equation to filter out any autocorrelations in the regression. So here we have our regression results. So the key points are, firstly, the impact of the lagged value is significant and positive across all the quantiles. And when the price gap is higher, it is more sensitive to its previous values. Secondly, the impact of gold imports is negative and significant for lower quantiles, that is when the price gap is low. Thirdly, the impact of the LBMA prices is significant and positive across all the quantiles. And interestingly, when the price gap is higher, it is more sensitive to the LBMA gold price. So an increase in LBMA gold price leads to an increase in 0.73 units of price gap when the price gap is higher. Custom duties, as we expected, an increase in custom duty leads to an increase in the price disparity between the India and the international prices. Gold contract volumes also, whenever the price gap is higher, that is in the extreme quantiles, an increase in the gold contract volumes leads to an increase in the price gap of approximately 1.12 units. Again, Nifty index is also significant, and the impact is negative at almost all quantiles. And interestingly, like so the R-square adjusted R-square value for higher quantile is it's quite large at 0.662. And a key implication is that the higher price gaps is more sensitive to the changes in the explanatory variables we have looked in this study. This is the, here we plot the coefficients of our explanatory variables across all the quantiles in order to show the asymmetric effects of these variables. Yeah, and in terms of our next step, we would be looking at the level of imports and the custom duties which is required to keep the price gap within a specific gap.